Good evening, everyone. My name is Shankhosh Dithar, and today I'll be giving a presentation on the governance principles of the microfinance industry. So, without wasting any time, let's get started on it. So, when we think of microfinance in India, we often think of small loans to rural entrepreneurs because, as we all know, that the MSMEs are the backbone of the Indian economy. Now, the MSME couldn't afford the capital what the big corporates can. The cost of capital is pretty much low for the corporates because they have a stable credit rating. But for the MSMEs, it's a whole new different story. Now, microfinance, it plays a very crucial role for all these emerging MSMEs. Microfinance not just give them a loan, but also running the backbone of our country, which is the MSME industry. For the small MSMEs which has an annual turnover less than 50 lakh or 1 crore, for whom the cost of capital is very high for banks, microfinance is a crucial important body that is giving them the hope at the loan in order to be a successful business and at a crucial starting point of their life. So when we think of microfinance in India, we often think of small loans to rural entrepreneurs, but there is a deeper story there. Microfinance has evolved from simple charity into high stakes, highly regulated financial ecosystem. As you can see here, Indian microfinance operate on a dual objective. They have to create a social impact through financial inclusion, but they must remain financially sustainable. As you can see, the part of the reason why the cost of capital is pretty much very high for the MSMEs is not because of the fact that they are relevantly new to the industry, but it is because of the fact that the collateral is very low, they don't have a particular credit rating and things like that. So microfinance cannot just give them loan on the basis of a new industry. They must also look at the financial sustainable so that all the loans that they are being disbursing to these MSMEs are not becoming NPAs. So think of governance not as a hurdle but as a foundation that allows a small NGO to grow into a powerhouse serving millions. When we look at the structural reality, now you can see that the microfinance industry actually built on the basis of four distinct legal paths. You have your cooperatives and trust at the grassroots, and Section 8 companies that focuses purely on social impact without giving out dividends. Now this is a very important thing from the perspective of our country for the microfinance industry as well. But look at the market reality on the slide. NBFC microfinance dominate about 75% of the sector. Why? Because to reach the scale India needs, you need commercial capital. Therefore, profit and scalable, regulated strictly by the RBI. This transition from NGO to NBFC is what has truly moved the needle on financial inclusion in our country. When But how do we ensure these for profit entries don't lose their ways? Because as we all know, as human beings, everyone becomes greedy. When profit starts to come in, the stakeholders of the businesses wants more and more profit. And for that, they try to take unnecessary risks that could be avoided. But for the greediness of becoming more profitable, they try to take higher risks. They don't follow the guidelines that has been prescribed by the regulated body, in this case the RBI, and they overlap those guidelines in order to make more money. So how do we ensure these profit entities don't lose their way? We look at the board, the management. The board is the moral compass. The RBI mandates fit and proper criteria. You can't just have anyone running the show. They need integrity and experience. And more importantly, we require board independence. It's not like that a member of a board has been pressurized into taking a decision which is not sustainable for the business. Having at least a third, often half of the board, should be independent directors, prevents promoter dominance. For example, two friends can tie up and try to uh, make decision on their own and overhauling their decision of other board members, and that is a part of the reason that at least a third, often half of the board should be independent directors, and that is the reason it could prevent the promoter dominance. This directly leads to the transparency. We use the fair practices code to ensure no hidden cost. We provide a key fact statement in the local language. If a borrower in a village doesn't understand the debt they are taking on, that is a failure of governance. accountability isn't just about a buzzword, it's a mandatory requirement to credit bureaus and regulators. As we all know that in our country, we have a very diversified cultural and language distinguished barriers. Now, for example, a small MSME business owner might not be understand and must not be familiar with the English. And based on the, for example, a microfinance company can fool him by giving involving him into a debt trap just because he couldn't understand the language of English. So transparency should be there. All the risk and risk associated stuff should be mentioned on the language that they are much more familiar with, that they are much more comfortable with, so that the transparency is there and there shouldn't be any kind of hidden cost that is being associated with that particular rule. On to the next. So the next topic that today, next slide we will be discussing will be the risk, ethics, and the ladder. Let's talk about the elephant in the room. Risk. We all remember the 2010 Andhra Pradesh crisis. It taught us that over-lending is a systematic disaster. Today, ethical lending is just smart risk management. We check credit bureaus before we lend to prevent over-indebtedness. We prohibit coercive recovery or uncertainty collection hours. Operationally, we use the joint liability program model. By lending to a group, we manage credit risk through community, support, and peer monitoring rather than traditional collateral, which these borrowers usually don't have. For example, a credit bureau must ensure and check not just the credit scores but also the amount of debt that has been undertaken by the MSME. Let's for example, some business owner might have a good credit rating, but he has already taken a huge debt. Now, if he further wants to refinance his debt by taking another debt, there will be the interest will pile up, and it might become fail, and the loan that has been provided to him by the microfinance company will turn into a non-performing asset. So, risk ethics should also always be complied with the RBI guidelines and things like that. To wrap up, the numbers back this up. The RBI requires a 15% capital adequacy ratio and ensures that 75% of a microfinance industry's assets are through microfinance loans. This keeps the mission on track. Ultimately, microfinance is about providing ladder, not a trap. Governance is the frame of the ladder. We never lose sight of the human being at the other end of the transaction. We should make sure that the true objective of the microfinance industry shouldn't always be just making profits and taking higher risk and charging higher interest rates to the small MSMEs and people who need these loans very badly in order to start up their business. And how can we ensure that? Through proper governance, by ensuring that we must follow all the guidelines that is being provided by the Reserve Bank of India. This not just ensures that the MSME sector, which is the backbone of our country, is on a solid track, but also the microfinance industries companies balance sheet as well. The NPI shouldn't be as much higher. It should be given more and more loans should be given to small MSMEs, which can support and eventually help our country to grow at a faster pace. Microfinance industry is not just a normal any kind of industry, but it is serving the backbone of our country, which is the MSME, and good governance is a true essential guidance that needs to be having. That's all from my side. Thank you.